Well, let's get to our first topic of discussion now. The Nigerian economy has been classified as one of the most volatile economies in the world due to its high dependence on oil revenues, as economic instability is witnessed yearly through rising inflation, massive unemployment, low output, and dwindling foreign reserves that has resulted to unstable exchange rates. The country's economic potentials has no doubt been constrained by many structural issues, including inadequate infrastructure, tariff and non-tariff barriers to trade, obstacles to investments, and lack of confidence in currency valuation, limited foreign exchange capacity, and a worsening insecurity, which is posing a threat to the growth of foreign direct investment into the country. Now, with Nigeria being an import-dependent economy, the impact of the Russia and Ukraine crisis on the economy has seen a steady rise in the price of food, commodities, and energy costs, causing a social-economic hardship, of course, on the masses. Well, let's break all of this down and understand them more. I'm being joined live in the studio by the Chief Investment Officer at Afri Invest West Africa, Mr. Robert Omotude. Thank you so much. It's good to have you this Monday.
Thank you for having me.
Yes, the big one. I'm going to start with the big one. Finally, the monetary policy, that's the CBN, has come up with this plan to redesign the notes. That is hot and it's everywhere. I don't know what you think about that. We have a lot to grapple with. Do you think this is what we should be looking at this time?
Well, I think that timing, it's I won't say it's wrong, but I think that, within the buckets of issues, macroeconomic issues, including monetary policy issues that we have to grapple with, it doesn't seem to tie well with one. It's not a solution to any of our problems right now. That's the truth. And if we are going to really dissect the data, we will know that it's not the solution to. It's not going to tackle inflation. If anything, it can worsen it, because one of the consequences of this is that we are technically going to see a lot of stockpiling of USD, especially for those illegal flows. So the CBN is right in that there is a need to constantly redesign the current. Increase the security features on the currency so that it can reduce the incidences of counterfeiting. Now, but the thing is, when you look at it in relation to, I don't think that redesigning is what you need to do, for example, to increase security features. You can have the same, design, but input constantly security features that, counterfeiters are not necessarily going to be aware. So they're going to be struggling a lot. So there shouldn't be too much lag, as the central bank has said, but that can be introduced without, such that new currencies coming in. There are ways central bank does this from time to time. When you have a case of mutilation or bastardization of the currency in terms of the physical look, as they get into the vault of the banks, they are advised not to take them out into circulation again. And then central bank issues new currencies, and without making any noise, you can actually do that and achieve it. But this redesign, as if you like, is just, I think I can liken it to a situation where your house is on fire and then you're trying to clean up the sitting room. The house is on fire. Do you understand? So in the bucket of issues we have to deal with, it's not the necessary one, to be honest. As much as we can argue that there's a need to actually, increase security features on currencies in order to not create incidences of counterfeiting. But when you look at data, right? So let's think about it. The central bank is worried about the currency outside the banking system.
Yeah.
So, within the scheme of things, we have currency in circulation. The currency in circulation is the physical cash that is actually printed by the central bank from the stock of money supply. So you have currency in circulation, demand deposit, the two making up what we call, narrow money, M1 calculation of money. So, but to make it broad, you then say the M1 and the M2, of course, which then increases the time deposit. But of the elements, only currency in circulation is the physical cash. that you're talking about. And then when you look at data, in fact, we went as far as looking at data from 1960. From 1960
To date.
till date. And then we found out that the average ratio of currency outside bank relative to currency in circulation, has been within the, 50% levels. That is currency outside bank relative to currency in circulation. It has been within that sort of 50% threshold, or 80% threshold, I mean. Now, if you look at that, think about it. The currency outside bank, the reason why you are printing currency in the first instance is so that people can have them physically in their hands. Let's look at that logically.
Yes.
You print currency so that people can have it in their hand. If we have financial inclusion, so much more that everybody is cashless, there will be no need for currency in circulation. Now, if we have currency in circulation within the banking system, that is a problem in itself. It means that why are we printing those currencies if our financial system can effectively capture them within the banking system? So the essence of printing in the first instance is so that it can be in the marketplace. So that argument doesn't really quite work, because the thing is that even if we achieve 90% financial inclusion and most people are banked, most Nigerians are banked, even if we now have only 500 billion naira printed in physical cash, that ratio will not change. Because the idea is so that people can have money in their hands. Because the moment you're printing cash and it's still sitting in the vault of the banks, then there is a waste. Why are you spending money printing those cash? Do you understand the argument now? So the logic is that the idea about currency in circulation in itself is that so that those currencies can be printed physically. So the fact that we have, in fact, if you look at the data, you will see that from the highs of 80% levels in the 60s, talking about currency in circulation to the total monetary base, like the broad money supply, it has dropped from the highs of 80% level to the current level that it is right now, which is around 8% or thereabout, below 10%.
Yes, it is.
Yes, so currency in circulation as a proportion of total money, broad money supply, is below 10% as we speak. So when you now further disaggregate and you look at the data the central bank is talking about, which is the currency outside of the banking system, right, relative to currency in circulation. In fact, if you take currency outside of banks as a proportion of total broad money supply, then what you have is a ratio that is perhaps less significant than 3% of the total money supply. So if inflation is a monetary phenomenon, this issue, if it's going to address anything at all, which it's not going to, it's going to have only about 3% impact on the overall problem. Because that's what the data says. This is central bank data we are talking about here. That is what the data says. So the issue now is that, let's think about it. How is inflation created? We say inflation is a monetary phenomenon because we are increasing monetary base through the activities of the banks and the activities of the central bank, So these ways and means increases monetary base because we are printing money without corresponding economic activities and we are advancing to government. That has inflation implication. Also, when banks create loans, right, it has implication on the monetary base as well, because there is the technical money creation we talk about from the reserve deposit of banks relative to the total deposit they carry. Now, this currency outside of banks do not have the capacity to create money, so to speak. They are currency outside of banks, so they don't have the capacity to create money. So to that extent, their attendant impact on inflation is muted, such that it is not what we need right now to really solve inflation problem, if there is any. The only valid point the central bank has is that this perhaps will help in reducing the incidences of counterfeiting. For me, that is the most important point that the central bank has to advance. But to say that currency outside of banks is 80% of currency in circulation, that is what it's meant to be, naturally.
If we are to now look at some of these critical issues that you think the monetary side, which is the central bank, should look at, many will say just in 2-3 days that this announcement has been made, On the FX side, that's the other market.
Yes.
The dollar is trading for about 800 naira.
No, that it's expected. So let's think about it this way. You know, when there is a major move like this,
Yes.
particularly looking at the timing that the central bank has, I think by January ending or so, everybody is expected to have submitted the old currency for the new one.
Yes.
And then it's on a first come, first served basis. So I don't even know, maybe there won't be sufficient, availability of that, So the tendency is that this is not likely to solve, capturing the illegal Naira flowing. So when I say illegal, not necessarily counterfeit, but maybe monies that have been earned through corruption or all those illegal activities. The tendency is that what they will start doing now is to stockpile USD. Because, they can't take the monies to the bank because they can't probably justify how they got that large amount of cash. So what they will still continue to do is to play within the domestic FX market. The funny thing about that is, even though its currency in circulation is small, it's similar to what happens on the Nigerian stock exchange. When you see a stock that has about 32 billion shares outstanding, or maybe only actively 1 billion of those shares are traded week in, week out, year in, year out. But those 1 billion can actually determine the fate of the entire 32 billion. That is what happens in this case. Because you see, those small amounts, even though they are minuscule relative to the total money supply, in terms of broad money supply, because there's a lot of pressure. People are bringing out the Naira in large volumes, and they are ready to buy the dollars at any amount. Don't forget, they lose the entire thing if they don't take a move. So they will be ready to pay any price to get the greenback, which is the USD, so that when the new currencies come, they can exchange again. So technically, we have used this to also put further pressure on the currency by this particular action. And that will have implication on inflation.
Before now, we increased rates to about 15.5%. Now, that's also in my intro. And we're yet to see any effect or any impact on inflation. But many will say maybe there's supposed to be a transition period before we start to see the impact of that. Which is which? Which do we need to focus on? Just last week, Moody's also downgraded, all saying that the issues around our external debt issues and all about that. So which do we need to address or tackle at the moment?
You see, when central bank started, the Monetary Policy Authority started increasing rates, I think about 3 meetings ago.
Yes.
I think that rate increase started sometime around June.
Yep.
July. July, if I'm correct.
July, August, September.
Thank you. Now, if we started, I think maybe around May. We had one in May. We had in July. I think we had in September. So the November meeting, we don't know what is going to come. But what happened the first 2 times that rates were increased, the Treasury bills rate was not really responsive. In fact, the bonds market was largely quiet. In fact, the OMO rate did not move. OMO is the rate at which central bank is selling securities to the the banks and all other eligible participants. It didn't move an inch. Just recently, we started seeing moves on the Treasury bills. So the translation of that rate hike, we're just going to see the impact now. Because before, we were being theoretical. We raised MPR, but market rates remained where they are. But recently, because of the pressure to also raise more money for the government to fund the budget, the DMO has done some tweaking to Treasury bills. I think the last Treasury bills rate closed at 14.5 on the longest end. That is technically about 17% yield. It is now that we can now begin to see the impact of interest rate hike on inflation, if our inflation can be any way tackled by increasing interest rate. But before now, what we saw was that market rates were not moving an inch. So, but now, if MPR is increased again, and we see the translation into Treasury bills and bonds yield, by the time the DMO comes to issue instrument, then we can begin to talk about transmission mechanism into the general economy to tackle inflation. But I think we still have a long way to go. The modeling that we have done for inflation suggests that before we can talk about any form of moderation, we'll be getting to May, June, if not July of 2023. So, and as it is right now, with all the election spending and some of the things that are going to hit by the middle of, I think the federal government has advised that subsidy will most likely be done away with by second half of 2023. So that means new pressure points will come again. So Inflation has a long way to go in this country right now in terms of putting a rein on
This
it.
is worrisome. The CBN also talked about kidnappers and all of that, getting monies in cash. That this could also help maybe address insecurity one way or the other. But that on one side, just like follow up with what I asked you earlier, where do we go from here? Where do we start to resuscitate or readdress issues of this economy? Because we still remain round the same ball. We just keep going round and round, and we stay at the same point. We're moving towards an election year and a lot of shift away from economical issues because everyone is focused on
politics.
who becomes president.
Yeah.
So while we're doing that, what happens to our economy?
So I think that on the point you mentioned about insecurity and people paying ransom in cash, it's somewhat arguable, right? Someone could pay in cash, right? And now with this policy, somebody could say, okay, rather than pay in Naira,
in dollars.
Do you understand? That's one way. The other way is even those who have the stock of the Naira, because there's an informal market where people exchange cash for cash.
Yes.
Naira cash for dollar cash.
Yes.
They can still get that done. So it's arguable how much of a solution this will provide even to insecurity, right? But where do we go from here?
Yes.
We need to, we've talked about this over and over and over.
Honestly,
so the issues that we're grappling with, they are so much. The downgrade by Fitch, if you read the report, a lot of our macroeconomic issues that are embedded in the report. The fact that we've seen oil price recovery, and the government has not benefited much
at all
from it, if they benefited at all. Countries like Angola are even getting upgraded in terms of their credit rating, and we belong to the same, OPEC, where we sell oil to improve our economy. Unfortunately, we have not seen all of those benefits. So one of the things that we need to begin to focus on are the right policies that are not antithetical to market principles. Because why we are here is because we have chosen to not embrace market principles in every aspect of our life. Talk about power, talk about petroleum sector, talk about our exchange rate management, even in interest rate management. Today, most countries of the world are increasing interest rate, and interest rate is much more flexible. You see a US paying as much as the current rate band for US Fed fund rate is between 3.3% and 3.25%. This week, we expect that there will be another 75 basis point increase, which will take it to 4%. Already, the market rate in the US is responsive because US 10-year yield, 5-year yield, even 3-month yield, they are all above 4%. But we raised interest rates almost 2 quarters ago. But it just recently the market rates, began to respond, So now, if we really want to attract capital, for example, into our country, the sort of interest rate we are paying right now is not what we need to pay.
Yeah.
So even in terms of capital attraction, capital importation into the country, we are not following with the way of the market. I have a belief that if we embrace market principles, we can solve to a very large extent most of the problems that are facing us. Look at the official exchange rate at 430, 440.
Yeah.
It just seemed like we're wasting the reserves because market has moved, but some people are still getting rate at 430, 440. When market rate can actually be adjusted to, catch up with the reality of things. So it's for us to do the right thing. Unfortunately, like you said, it's electioneering campaign, politics, has taken over every aspect. And unfortunately, we have to live with this until a new president is produced. And by then, we can now start talking about, moving the economy again.
Oh, well, it's worrisome, but it's on that note that we have to just leave it. Interesting conversation, because I know if we want to keep talking about burning economic issues, 1 hour won't be enough for us to talk about this. But I must thank you for starting the week with us on the show. Chief Investment Officer at AfriInvest West Africa, Mr. Robert Omotunde, there, explaining and giving us his insight into this very important topics surrounding Nigeria's economy. Do enjoy the rest of your day. Thank you again for your time.